And we're live. This is This Week in Coverager. This is the podcast where Avi and myself and the coverage team, we discuss topics for the week, be them hot news topics, topics that clicked well on Coverager, and we debate them. And as many of you know, lately we've been having guests on to diversify the opinion a little bit. So first, I'll say hello to my co-host, Avi. Good
How you doing?
afternoon.
Hello.
And Hari, hello.
Hey, hello.
It has been a long time. Why don't you give the audience a quick introduction to who you are, and why your opinion is going to be valuable here?
I don't know if I can validate why my opinion will be valuable, but my name's Harad. I'm the CEO, founder of Verikai. We're at high level applied data company. We have 4,000 variables on 260 million people. It spans a range, right, of demographic, social, econometric, financial, purchasing. But probably the most valuable and important part of what we do is we, from our carrier customers, get lead conversion and claims information, right? Effectively, first dollar incurred claims over a contiguous period of time, anywhere from 3 to 5 years. And from that, what we're able to do is project the behavioral contribution to loss ratio of every American by any product line, right? And what that allows you to do, actually, it's kind of interesting. The reason we did it is it actually allows you to realize the gap that sort of exists between where an actual rate is set and where underwriting is willing to approve a person for a product. And it becomes very, very clear, very, very quickly, actually, when you look at the information, that human underwriting is like the easiest cause of singularity, right? That's how the machines are going to win, because everything from what we can tell from an underwriting perspective is very much anecdotal and very much bias driven, right? And I kind of view it as a control that the carrier has to be able to sort of sit there and say, I can fluctuate between volume and profitability as capacity changes, right? And that's its like sole purpose. And the thing that's changed and why I feel all of it has to change is interest rates are just so low that if you're a carrier right now, like everything about your expense ratio is awful. Like, no matter how you look at it, it's just all like just awful for you because you don't have any compound return on capital. So everything about insurtech is great because you look at it and you say to yourself, hey, these guys everybody in insurtech wants to fundamentally flatten a lot of these expense costs, right? And so that ends up being the driver. And for us, we feel that the real value is, can you transfer some of that locked in profitability that's sitting there on the net premium side and defray it against expense ratio, right? That when you look at what the cost of underwriting is versus what it costs to actually close a customer, it one really outstrips the other, and people don't.
Yeah.
Right. So thank you for the time. And
well,
I like being invited to a panel of opinionated people. So
we're gonna get into it. So I hope there's gonna be some arm wrestling. But if you haven't been able to tell already, Hari's very smart. Okay, so it's fun. Like, you know, you go through your LinkedIn profile and it's like, the dude's got a medical degree, right? And he's an entrepreneur, and he's an insurtech, and like, you know, so it's hey, welcome. We value your opinion on here, and so let's get ready to rumble and talk about the one topic that we're going to talk about this week. But looking forward to getting both Avi's and Hari's opinion on it. Avi, what's the topic?
So we talked about this a few weeks ago, but now it's official. Root filed for an IPO, talking about valuation, rumors, of course, around $6 billion. So I'll start, kind of, what is your big takeaway from the Root filing?
I mean, I think my big takeaway from the Root filing is that obviously, like, cost of acquisition completely outstrips like premium capture, right? Like, if you went ahead and said, I'm going to start a full stack carrier from scratch, and you weren't living in the times that we're living in right now, where the cost of capital is so pathetically low that like being able to sell a lot of lemonade in a stand is somehow like a great business. What you would do is, if you were any other carrier like Progressive, you would just sit there, point at Root, and laugh, right? Like, when you're Progressive, all of this is funny to you. It's all funny to you because you are the alpha and omega of the auto business, right? You're the only auto carrier that's been able to take credit and bury it into age, gender, and industry. Nobody else has done that, right? So you have every age, gender, geo rate you have has credit already built in. So when every single regulatory board goes, oh, I got to get rid of credit, Progressive's the only one who can still keep their rates. So anybody who's like we see it with some of our auto customers now, effectively when we tell them what's underwritable, the cutoff is what will Progressive take. The cutoff is not what they'll sell. The cutoff is what Progressive can buy. And that tells you everything you kind of need to know about the auto business. So when you're looking at anyone on an insurtech basis that's trying to build a full stack auto carrier, the first thing they have to do is figure out how to underwrite better than Progressive. And if you can't do that, then the only thing I'll see in your P&L, I suspect, is here's new premium written, here's its loss ratio, which outstrips it, and oh, by the way, I have a ton of churn, right? And it's just all about juggling what that means to a naive set of investors. And that's what we're really talking about, right? If you're signing a $6 billion valuation in that route, you're ignorant. That's what I mean.
Yeah.
So let me ask you this. I mean, it's a fair point, but we saw, I think, months ago, Progressive bringing back to life an initiative that happened years ago, where kind of you feel like it's an answer to Root, allowing customers to download the smartphone app, measure how they drive, and maybe Progressive can offer them a better quote. So definitely, kind of it's looking at Root. So you think Progressive, from what I understand from you, you shouldn't be worried about Root, but do you think they're worried about Root? Do you think Root is bothering Progressive or Geico?
No, I think nothing bothers Geico, right? Because the way Geico does business is you just, when you walk into the Geico building, you just hope the lamps don't fall on you, right? Like that's how their ability to keep the expense ratio low is they spend nothing on operating costs. So Geico's like Warren Buffett's like wet dream as a business because the expense ratio contribution to that business is just so low. So Geico's not about like underwriting better. That's not their game. For Progressive, so the thing that's really interesting is that Progressive abandoned the whole, they didn't abandon the whole dongle, but they got rid of the whole dongle thing because you know what they learned? What they learned was the people who opted into that dongle were already low loss ratio, right? People with highly compliant behavior are the people that opt in to say, I'll take the dongle. And so they're sitting there going like, great, we went ahead and manufactured the dongle. It's got this kind of cost. And it's actually not really something that's going to change the loss ratio of the people that have opted in. The one benefit that dongle had, and they sort of buried it at the time because they didn't think it would matter, is it had great marketing value. So it had a lot of marketing value around people who believed that like the fact that they had that dongle in there somehow got them a better rate. What people don't realize is that having that dongle in there just means you're not going to get re-rated as badly. So you can sit there and say that that's a better rate, and I suppose in theory that it is. But I argue like if your underwriting wasn't completely idiotic, you would actually get the rate right the first time anyway. But assuming that you can't get the rate right the first time because you need more volume than the value that you create, then you sit there and you say, great, like I just want to minimize how much the re-rating is going to be. And so for Progressive, like being able to sell that conceptually was really it's the same reason we do good driver discounts, right? You do good driver discounts because the thing that's killing auto is churn, right? It's not, it's the initial rate and the re-rating that now is really obvious from an internet basis where I can just go get a better rate from somebody else that's posted in some comp rater means there's no loyalty, right? It's like the only people that are loyal to auto are dual eligibles. In fact, what we found is the best auto customer that isn't an auto customer to go after is somebody who just got married or is going to get married this year. They're phenomenal, right? The cost of buying them in market is low and their rate of return from a loss ratio perspective is unbelievably high because their accident profile goes down once they get married. They usually end up insuring more than one car, so you get multiple policy values. And they stay on policy. They don't churn, right? So I think that like when I look at what Progressive decided to do there, I think they decided to do it because they realized, oh, I remember that it had marketing value. Like I'm going to go ahead and put it out as marketing value because these guys again at Root are doing my marketing for me. Like the minute they go and say that that's interesting, I can just dust that thing off and put it out there. Progressive isn't changing their rates because of anything that thing says. I can tell you that for a fact. That I know.
Well, interesting point. Progressive made an all-time high today. So what does that mean, right? Like, you know, I think I glean a couple of elements from what you just said. One is I scanned through the S1, and as I was reading the purpose of who they are and what they do, and I'm gonna caveat this to the audience. I'm putting my investor's hat on. So if it comes off a certain way, I'm just going to look at it. Would I invest in this company? And as I was reading it as an insurance professional, it's like, this wasn't written for me.
Nope.
Right? Like, this was written for someone that doesn't know a lot about insurance.
Doesn't know anything about insurance. It's a lot like lemonade, right? It just, you don't know nothing about insurance. You may know a lot about marketing, but don't know a lot about insurance.
Yeah. So that's sort of stood out. And I'll go back to Avi, a couple of the, you know, when Root has been brought up before in other This Weeks in Coveragers. I again, putting my investor or VC hat on, I struggle with auto. Like, when I think of, well, what's the total addressable market? Auto is huge, right? But I keep hearing about autonomous vehicles. I keep hearing about the future death of auto insurance. I've seen Warren Buffett comment on it. I knew it wasn't imminent, but from an investable point of view, I'm just like, that's not. If I were a VC, I would be extremely worried. I think there's probably limited upside. They would need to move quickly, steal market share, do it profitably, really jack up the valuation of the company, because the end might be near on, 10 years from now, 15 years from now. So those kinds of things stick out to me.
I mean, it took Root just a few years to get to that massive valuation, so they are quick. And obviously, you talk about the potential autonomous cars, connected cars. If Ford wants to now become maybe not an insurer, but to offer insurance to their client base using their data within vehicle cameras and all their technology, they could forget about the underwriting 1 second. They could really help prevent risk. They can do that. No one else can. An automaker can. But Root got to the end zone. That's the thing. They got to that point, just like Lemonade did. Yeah,
absolutely. Hats off.
Hats off. Yeah, absolutely, 100%. Like, I mean, like let's put it this way, right? I literally met a buddy of mine, a really good friend of mine, who got catfished by a girl, right, on the internet, and ended up marrying her. So hats off to her for catfishing him and also somehow marrying him. Like, really, really impressive stuff, right? Like, that doesn't mean it isn't like god awfully stupid, but it is great that you can get there. Like, I think here's the problem, right? The problem with here's why it's a problem. Why it's a problem is because every one of us that's on this call and all the people that are listening, we're committed to this ecosystem. This isn't a quick buck for us, right? We're not in here just to be able to sit there and say, hey, I've got a really interesting home insurer, because what I do is I sit there with every mortgage originator and I get first shot at a policy, right? To me, that's not. I mean, to me, that's a great idea and a great business. There's no argument there. But the minute you run out of everything in insurance is about underwriting being matched to CPA. That's all it is, really, fundamentally. And I argue that insurtech's real value, because you nailed it, right, Nick, when you said it, which is the real value of insurtech is, I'm the policyholder, here's tech, here's the reinsurer, right? They're the ones with all the capacity. It's not these carriers. The reinsurers are the ones with all the capacity.
Mm-hmm.
There isn't a single reinsurer in the world, not one, that if you went ahead and you were in an elevator stuck with them and you turned them and said, hey, listen, would you like to just write policies directly? And they'd go, yes. Yeah, I have a ton of capacity, but that's my problem. I have nothing but cash.
They don't know how to sell.
Yeah, exactly. They don't know how to sell. So the minute that all these insurtech companies can actually go ahead and accelerate that process of selling, which is why they're all targeting it, right? They're all fundamentally every single insurtech is doing the same thing, which is I'm going to talk about broker agents last. I'm going to come into market and say, I'm going to call myself an insurance carrier. You don't know the difference between an MGA and an insurance carrier. I'm really an MGA, but I'm calling myself a carrier. I'm going to be a brand. I sit on somebody else's paper. I get out there and everybody goes, ooh, Hippo. That makes a lot of difference for home. Like nobody on the front end has any idea what it really is or what's really happening. And what I find interesting is a lot of the guys who've made it to the finish line, not to be like gender biased or anything, men, women, whatever, make it to the finish line, a lot of them come from marketing backgrounds. They don't actually come from like hardcore insurance backgrounds, like claiming, underwriting, or anything. They come from marketing. And they many times don't even come from marketing and insurance. And that's great, right? Because what it tells you is that that's fine. That tells you that it's a viable pathway to get where you want. But you make a great point, Nick. Like, there's going to come a time, and I don't think that future is just so radically far in the future. It's really interesting. Like Elon Musk posted, like somebody posted something about Elon Musk and like rethink. Like, I want to find a really brilliant actuary. So I wrote Musk a private message and I said, you don't need a brilliant actuary. You just literally need to know like if there's anything about the owner behaviorally that you put in the setting of the car in any way, shape, or form that could affect the possibility of you getting in an accident, right? Because the minute you can underwrite the manufacturer, right? The manufacturer's risk of the car itself, it means that you uncouple it from the one thing in auto insurance that nobody can actually leverage to predict, which is the behavior of the individual when they're not in the car. We talk about all these other things that people do, but I can tell you, because I know this for a fact, if you're the kind of person who pays his mortgage late, you're also more likely to get into an accident. You're also more likely to file against your home claims. This is nothing I'm telling anybody. Like if I tell you this, you're not going to sit there and go, yeah, like that's fairly obvious. Yep. The minute you uncouple that, right? The minute you say, I'm going to have the smart home underwrite itself, or the smart car underwrite itself, your underwriting and your actuarial rate are now almost completely aligned, because the only reason that delta exists is the individual's behavior. That's the only reason that delta is really driven. So that's if I'm looking at auto insurance, that's my take on auto insurance is I mean, I don't think it'll be overnight. And the reason it will be overnight is because I suspect the autonomous cars require, right? Like one of the big issues that even Tesla has is that a lot of things that you do in mass production are hard to do with electric cars today. But that won't be the case long term, right? Like it'll come to a point where you'll be able to do production level vehicles that are electric. You'll be able to do production level vehicles that are autonomous. And at that point, like if I'm the autonomous manufacturer, I'm going to sell the auto insurance right through the car. Like I'm going to sell it if you sell car warranties, right?
Well, Avi brought this up a couple weeks ago, and I mean they have the superior technology. Whatever they're going to put in the car is better than what's on the phone.
Yep, without a doubt.
There are all kinds of drawbacks to having it on the phone, Avi. Like
the battery.
You were mentioning
the battery. That's what I said. I think Root really, in my opinion, Root should build a better battery, because then there'll be a car insurer, but also sell batteries. Maybe Apple will buy them.
I think it's a gimmick. I think it's a gimmick.
You know, you talked about marketing and this is that, and you talked about Progressive and to think. And it's funny again, because they admit with the battery problem, because even the best marketing plan, when it's not based on a good foundation, you'll find holes. You know, that's what happens. And this is what happened with Lemonade, and it's happening with Root. So they're saying that they're going to use the telematics, the smartphone, to continuously measure how people drive beyond the test drive period. Now, you start to think, 1 second, who is this company that says that we're only going to measure you for 3 weeks because that will be the indicator of how you're going to drive for the rest of your life? Everybody can game the system. People know it. And just looking at their loss ratio during the pandemic, of course, less driving, so the numbers go down. But you compare it, for example, to Progressive, as you mentioned, what a difference. Because still, Root relies on young consumers that still have to drive even during the pandemic. They may be essential workers or whatever that is. So, and when you look at Metromall, for example, this is a good comparison, because Metromall, you could say a lot of things about them, but they are very clear communicating what the product is, who's it for, people that don't drive much. Their loss ratio in the second quarter, just the second quarter, went down from the first quarter from 74% to 14%.
Oh, you mean at Metromall?
Metro Mile. And
it makes
think,
perfect sense because
think about the driver demographic. People maybe
totally.
that don't drive it to begin with. So a pandemic, I don't need to go out. No big deal. I don't need to go to the office anyway because I probably don't drive my car, and that's why I need a pay per mile insurer. So you see that, and it really is about attracting the right customer. And I feel like with Root, obviously it worked for them for the IPO, and I bet you it's going to be a great IPO. But they've attracted a good consumer, like you said, with the dongle. I'm willing to let you see how I drive. I believe that I'm a good driver. But then they also attracted the people that said, let's game the system. For 2-3 weeks, I'm going to drive like a grandma. And they did it, and the bad risk and bad loss ratio and all of that.
Yeah. I mean, listen, like the beauty of doing what I've always really liked Metro Mile, right? Who knows where they'll end. My only point about Metro Mile is the volume of inventory that exists. Unfortunately for them, it's just not large, right? It's just not going to be large enough for them to sit there and say I'm sustainable. But I would believe that because of the loss ratio delta they have, they can start to say that you can basically use the pay per mile as almost like a captive, right? You can use the pay per mile margin to sit there and say, I'm going to take on some stuff that's like more non-standard or more risk, whatever, and just sort of blend out your portfolio. Root chose the exact opposite thinking, which is I'm going to go ahead and sell this thing to everybody who's got a mobile phone. And some of these people will stay on the mobile phone, and some of them won't. But the thing that's the most interesting, and it's interesting because we actually have a customer where they have all of that telematics in the car. And so it's a car manufacturer, right? And the thing that's really intriguing is the behavior of the individual still completely overweighs everything that's in that car. It's not a surprise to any of us, obviously, that are here. But more interesting was they had also looked at the mobile at the mobile option, right? Because that's the easiest way to get somebody to opt in, as you would imagine. And what they found was that effectively what you're able to do is that ecosystem of people that you're willing to go ahead and give that to, their frequency risk goes down or is low anyway. The probability of severity is as randomized as it would be for anyone else. And so what Root believes that they can do is they can sit there and say, okay, I'm going to give this to everybody. I'm going to go ahead and give a discounted rate because you're willing to opt in. Anybody who's only on it for 3 weeks and does the grandma thing, they're going to get re-rated and write off the business. Anybody who has something happen, right, from a severity perspective, they're going to get re-rated and written off the business, and I'll keep the rest. Here's the problem from what I can see from the S1 is the churn on their book is really high. Like that's not like the thing that people know in auto is, and it used to be true 10 years ago, was if you weren't on a book for 3 years minimum, right? That's where an auto carrier net of CPA broke even. Do you know what that number is now? It's 18 months. 18 months, okay? So if you can't keep somebody on policy for 18 months, right? Like you're State Farm, like what did they lose? Like 10 billion or something? I don't even remember what it was they lost, but like a lot of that was churn, right? Just straight up churn. So you cannot support a business in auto. Auto comes down to retention. It doesn't because the retention is part of that CPA. If you can't keep a person on an auto policy for some period of time, 18 months, and it'll get shorter, right? Then you can't grow. It's just not sustainable. So I that's why I say I think it's marketing, and I think it's a great marketing job. I think it's a phenomenal marketing job.
It probably explains the bundling with homeowners, right? So they probably know that.
But only 5, I think they mentioned that the rest one, only 5.4% opted to bundle the renters with the car insurance in eligible states. But it doesn't look like a high number.
No, and the beauty of it is that if you bundle home with auto, your churn rate drops. You bundle renters with auto, it doesn't. Renters with auto doesn't actually reduce your churn rate enough because, as you would imagine, those people are transient. It's like they're renters. It's like this is the part that's hilarious to me. It's the same thing I saw with Lemonade, right? Where like people are sitting there going, "Oh my God!" I'm like, you're selling renters insurance, okay? Right? That's the thing that people buy to like insure their jewelry. It's like you're buying renters insurance. That's not a high premium product, right? So you are pouring a meaningful amount of money against a non-high premium product with the assumption that you're going to be able to have to upsell more to those people, right? And
they admit that.
Yeah,
That was on Lemonade's S1. Was this is we're going to get a lot of them, and then as they graduate, which was the word, we'll get them into the home, and maybe the future is auto and life and all of that stuff. But that was the plan.
Yeah. Good luck with that plan. So
yeah. So
I mean, seriously, how loyal are you to your renter's insurance? I mean, come on. If you told me that about auto, I buy it. But I don't even know. I obviously live in a home now, but I can't even tell you who my renter's insurance was when I rented 15 years. I have no idea who they are. I wouldn't even know, because in my personal belief, the only people that know what the brand of insurer is one of three reasons. Either A, you've done a phenomenal marketing job and they know who Flo is, or they know who, that's front of mind for them.
Yeah.
B, you've claimed and your experience was great, or C, you've claimed and your experience was shit. That is it. That for you, if you want to go and say who I am as a carrier, that's usually what it comes down to. So I do understand where they're sitting there going oh, the claiming experience for us is great. Do you know what the loss ratio on renters is and frequency? It's not high. Everything in that business is basically total loss, right? I lost my jewelry got stolen, that kind of stuff.
Yeah.
And that's why they can get away with saying, "Oh, I'm going to hand this all off to the reinsurer," because.
So let me ask you both a question. From an investor perspective, or whatever you want to, from an insurance perspective, if you had to choose to invest in Lemonade or Root, who would you choose and why?
I don't know. Can I go first?
Yeah.
All you, man.
I think I would go Root. Just because I think auto and homeowners has more legs. I think you can do more. I think Lemonade is going to struggle to go up the ladder. Root could, really, I think, fulfill a niche if they really wanted to. They're VC backed, so they have to think really, really, really big. But I think Root has more tools to be able to. They could go after a niche very easily if they wanted to, like non-standard, or they could do that. Lemonade can't. Lemonade's kind of stuck. They're renters. They can't. They're struggling to get homeowners. I don't see how they're going to be able. And that's the other thing. So, Harad, I want your opinion on that. Which one would you invest in? But in fact, they're now competing against each other. I can't see a situation where they both super thrive. But anyways, which one would you invest in, Harad?
Is neither an option? I don't know.
You have to choose one.
I mean, of all of the startups I've kind of seen that have chosen that I'm going to go the full stack option, I suspect the one that if they the one that has there's one that I didn't really know very well, but it's Clear something like that. I forgot their name, but
Clear Cover.
Yeah, Clear Cover. That seemed kind of intriguing to me. I don't know the business well enough to understand it. Meaning, I just haven't done the investigation, right? But because I don't what they do doesn't anyway. I'm sure it's great. I just don't. But it's Hippo, right? And quite honestly, I'm the first one to come out and say my experiences with Hippo as a customer and a partner haven't been great, right? And kind of sort of say that because I mean, and I can say this with Avi on the phone. He can go ahead and tell me that I'm completely wrong. But when you work with Israeli companies, you have to be you have to very much understand right out of the gate that you are not in any way, shape, or form smarter than them. And don't ever assume. And quite honestly, many times it's actually functionally true. But even if it isn't functionally true, just don't assume that. If you're going to come in there and say, "Hey, we can make something better," they're highly skeptical of anything that you'll do.
Yeah, that's why customer service in Israel sucks.
That's
right. One of the reasons.
Yeah,
because the customer is always wrong or stupid. That's one of the reasons.
Exactly. It's it's the customer's problem. So the thing that's intriguing though is when you can find a low cost of acquisition channel, right? There's a lot more leverage that you have. So for it's why every time
a good point. Very good point.
Anytime it would show up and you'd say, "Oh, Hippo's going to be, we're ready to go be a full stack carrier." I would literally write on LinkedIn, I'm like, "That is the stupidest thing I've ever heard. Don't you ever that's just so dumb, just so completely dumb." And then somebody from Hippo be like, "No, we're still going to be an MGA, right?" And then we'll just slide off into the universe. At some point, it makes sense for them to switch. The reason I think it's never a great idea is that in home insurance, the ceding to the reinsurer is going to be really punitive. It's only going to get worse, and it's going to spread across every market. You're not going to just pay a ceding premium to be in Florida. You're going to sell in Ohio, and you're going to be paying a ceding premium for Florida. So that's the reason that like full stacking home is such a dicey proposition, really, just because of the hardening of the reinsurer on the other side. But the one advantage they have is by selling through those mortgage originators, they've got a very, very low cost channel that is actually working well with the interest rate itself, right? Like, because everybody's doing what they are on that interest rate side of the business, that's a very, fairly low cost acquisition channel for them. And so because of that, if they ever wanted to say, I'm going to be full stack, they're not going to have an expense ratio burden. I look at the S1 for both Root and for Lemonade, and I'm like, there's nowhere on an expense ratio basis for them to go. Like, it's like the favorite thing I always see in coverage, which is really kind of like funny every time they do it, is somebody goes in and says, like, subtly, we're going to use agents, right? And immediately, like, it'll either be like, and I would be like, ha ha ha, they're going to use agents. I told you, right? That's the reality, right? The reality is you've got cheap capital, and you've got cheap capital coming into this market. It's going to go towards distribution, right? Because venture guys are dazzled by growth, and they don't care about margin in markets where the cost of capital is really low. So the thing that I think these guys have done, like Lemonade Root, and it's smart on their part, is they've been in market long enough that by taking someone else's money to cover that expense ratio gap, they look really good, right? It makes them look really, really good.
Yeah.
This musical chair will end. It always does, right? Like, I started my first company in 2008. Like, we sold that company to Johnson & Johnson for $6 billion. If I told you how long it took us to raise our seed round, you would laugh that I would have even stuck it out. Like I've seen these markets. They come and they go. They really do. And the thing that sucks is a lot of what people in insurtech are doing is great. And a lot of it is going to get buried in the wave of a couple of guys that are getting a quick buck. And
do you have an answer, Root or Lemonade?
I was gonna pass on both, but I would agree with Nick. Like, your best bet is probably Root, because when you look at it, Lemonade has a two-part problem. The first problem is that there is the whole expense ratio component. But the second part is the premium is so low. Like, right,
and Lemonade's customer acquisition, they share 283 per customer. Root is 338. So Root a little bit higher, but they get way more.
But auto's much bigger premium.
Much bigger premium.
So
yeah, of course, no, but that's the thing. And you know what? The thing is, like, you pay for a software engineer for renters and for auto. They don't care about the line of business. You still pay them 150, 200,000, whatever it is, but you're getting a lower premium. And so who do you think did a better job in terms of marketing to consumers, Lemonade or Root?
Lemonade.
Yeah.
Much better job.
Agreed.
I agree too. I think so too. But again, it happens just to be that the premium is so low, and although they sold way more policies and renters policies, which again is not compulsory, you don't have to have it. But I think they did an amazing job. But
they piggybacked off of they got free publicity around every corner when they first got started. The gun thing, and then policy 2.0, like a lot of stuff that I think insurance professionals just kind of rolled their eyes at, but their potential customers and potential investors ate up. Lapped it up. It was just like, oh my God, these guys are transforming the industry.
I think dyed in the wool. I think that there's a blind spot for dyed in the wool insurance people. Mm-hmm. It's marketing. That is a blind spot for them in the sense that when you're addicted to that agent broker channel, right? Like, how many carriers have you guys probably talked to that are like, we want to disrupt our agent brokers, but we don't want to know that they're being disrupted. I'm like, okay, yeah, good luck, man. Like nothing in insurance is more like true than the tail wagging the dog. That's what it does in this business, without a doubt. If a producer goes in and says, like for us, like literally the producer's going, why aren't you using Verikai to go ahead and quote the rate? Like the minute they do that, the carriers are like, oh, you're right, we should. Like it's completely inverted. And so I think that the thing that you see, and I give Lemonade all the credit in the world, is they're phenomenal marketers comparatively to everybody else in the industry.
Yep.
Like they're and makes sense if you look at their background. That's their background, right? They are marketing people. Like Pi, John's right. He's a marketing person. Like these are people with marketing backgrounds, right? B2B or B2C, and so they're bringing to an industry that is historically dependent on agents and brokers, right? And where marketing has historically just been about brand, and they're bringing demand gen. Like these dudes haven't seen demand gen monsters like these guys coming in. The problem is that the demand gen monsters coming in have no idea what the actual margin on the product is, right?
Yeah.
So it's kind of funny. Like somebody will be both, right? Somebody will be able to actually like, and they'll be, whoever that is will be the dominant, like they'll be the winner, the real winner in this business. It might be an existing player like an Amazon already, but it's probably, they'll be the winner of the business.
Yeah. Harry, I think you sort of hit on something I've talked about over several different episodes, which I think the two things that the black holes that I think these insurtechs are just going to struggle to get any sort of energy to pull away from their gravitational pull are going to be the reinsurance. And I'm amazed at how that's downplayed all the time. No one really brings that up. And it's just like, you can't, if you're that good, you can't sacrifice your upside to the reinsurer. And I say, and guess what? It's just going to get worse. Reinsurance markets are hardening and they're going to control your destiny. But no one has really, or no one that I know of has really skinned the expense ratio problem in insurance. And I was having a conversation with a friend yesterday about a small business insurtech that's going direct and using agent brokers. And he's like, what do you think about that? I'm like, it can't work. Like you got to pick one or the other because the agents are going to know that these companies are competing against them. Like they have other options.
Yep.
Because they can go to a Bold Penguin or an Ollie or a marketplace and get access to other things. And so those two things I think are like black holes that I think investors don't really pay attention to.
No, you're 100% right. I completely concur. Like, it's really, and I'm sure this goes out to the world, so forget it. I guess I'll go ahead and say it. But the reality, the thing that's becoming obvious to us is in certain markets that we're in, we're the rate. If we disappeared, there's no way for that, like in small group health, there wouldn't be any way for the business to move other than health questionnaires, which are awful, right? And so the thing that's interesting is there's many times I sit around and I go, why am I not just subordinating the rate? Like this is silly, okay? Mm-hmm. And the reality of the situation is the only reason I'm not is the reinsurer. That's the only reason. The reinsurer sat there. You can get the reinsurer to give you paper in anything in P&C because P&C is just so commoditized. It's ridiculous, right? It's hard to get reinsurers to give you paper in things in A&H because other than like final expense or something very, very low weight, like simplified issue term, because the rate of claiming is high and there's nothing punitive when you claim where the rates gets reset, right? In life insurance, when you claim, you die. So
that's it. It's over.
And in health, you can claim as much as you want. Your rate's not going to change. So the way the reinsurer views that business is different. I think that's the thing that has been the most eye-opening for me in this business, right? And I consider myself a novice compared to many, many other people, is that sales and marketing cost and underwriting cost are not coupled in any way, shape, or form. They're not even viewed under the same P&L. That effectively, I as an underwriter there's a guy apparently at AIG, this is a true story, that when you want to go ahead and insure a yacht, he's the only dude. If he goes on vacation, you can't get AIG to write something. Like I met him once, and it's like he like eats hot, he has bad habits, he eats hot dogs, he smokes. We'll go outside and I just asked him like, okay, it's a $50 million yacht. Like, why don't you want to ride it? He goes, he's like, just old school. Like, he's like, guys, rush and forget it. Like, it's just like, I don't even know. And that doesn't even seem like there's nothing mathematical about that in any way, shape or form. Right. So you sit there and you look at it and you realize very, very quickly that the lever that exists on one side of you're 100% right, that the lever that exists on one side of the business fundamentally should be coupled to the other side of the business. And I argue, in our early days, we thought that we could tie the two together and not worry about the producer. And we found out, I want to say within a couple of months, that was insane. And the reason we found out that it was insane was because you can create these things called lookalike audiences, right? And you can go post them in LiveRamp or directly, you can do right on Facebook. And what'll happen is not a single marketing organization at any carrier will be able to do it, right? They won't be able to last, because the one thing that you as a third party don't know is who doesn't respond, but Facebook does and Google does, right? So because they know who won't respond, they're actually the one determining intent for everyone. So if you think that you can, how you beat Google and Facebook? You get some idiotic private equity guy to give you 350 million so you can go public and get some other idiot people to put in more. You're not going to beat Google and Facebook on the intent of wanting to buy auto insurance, right? So what we realized really quickly is that the where we're really great and where I think there's opportunity is qualifying intent, right? That basically you can sit there and say, this is underwritable by the market, because the like Progressive's manual and Allstate's manual, they're not radically different. The difference is that Progressive has more price availability than everybody else has. They have a rate for everyone. And the minute you have a rate for everyone in auto, your cost of acquisition is going to be lower because you have a rate for everybody. Anybody who shows up at the door, you can give them something. Oh, you're non-standard? Cool. Here's $800. Oh, you're premium? Here's like, you can give a rate for anyone. So the minute you have a low cost of acquisition, right, which for Progressive is directly tied to a wide rate band, like it's game on, right? And so think about it this way: every time Root buys a customer, and every time they lose them on a re-rating business, in auto, the probability that it's going to Progressive is something like 35%. Which is why like there's this movie called Miller's Crossing, and it's got this great line where the guy who runs the entire gang goes, "You're only as big as I'll let you be," and that's Progressive in auto. They're only as big as they'll let you be. That's the business. That's how.
I'll say, Avi, that's sort of what I was saying when Lemonade did their IPO. I said, Lemonade can only get as big as the reinsurers are going to let them be. Right, like they actually control what's going to happen, and so I think fundamentally we sort of keep circling around that same thing, but customer acquisition is so difficult in insurance that you need a complete Michael Porter strategy session to just focus on that. And I'll tell you, or
you need to completely and utterly automate underwriting. Right, literally, it's got to be weak AI that's directly connected to your sales and marketing
to reduce that expense.
Expense.
Okay.
Because the cost of your expense ratio is basically two things, right? Whoever is getting your intent. So if it's the broker, you're paying them. If it's Google, you're paying them, right? It's whoever is like getting intent, and then whoever qualifies it. And the thing that's interesting is the qualification of intent goes into net premium, not into the expense ratio. So the minute you take that qualification of intent and you actually push it into the expense ratio, you're taking all of the margin that sits in net premium that nobody ever divulges, and you're able to pull it into expense ratio and become far more competitive. And in a high interest rate environment, you wouldn't give a shit. You would never do that. But in a low interest rate environment where things aren't compounding, that's your best bet. There isn't a better bet, really, at the end of the day, from what I can see.
Avi, never tell me insurance is boring. This was awesome.
I think I mean, to me, what it does really, and I look at Lemonade and I look at Root, and they were vocal, they were aggressive, they used that capital money to do something that normally you cannot for a new company, because things take time in insurance. And you talk about marketing, you talk about brand. I feel like this is to me the ultimate challenge of insurance companies. There are so many selling the exact same thing that's driven by price in an environment where consumers are now completely in control of what they hear and see. It's very difficult to get people to look at your product. And we talk about the bundling of customer that just got married, home and auto. they're not here to get Root to measure their driving for 3 to 4 weeks for saving $100, $200 every 6 months. They don't care about that.
Yeah.
They have other things on their mind.
Yep.
But that's where, again, you're vocal, you do that, but it does come down to marketing first. And I feel like a lot of insurtechs, and even insurance companies, I think they haven't figured that out. And it's just, to me, it's fascinating to see the two different approaches of Lemonade, because I'm torn personally, like, who is better, who is
Well, which one would you
playing.
invest in before we sign off? Which one would you invest in?
You know what? I don't know if it's because I'm an Israeli and they'll say, oh, because you're an Israeli. But I think if the folks at Lemonade, if they stop worrying so much about how they are perceived, and if they, because to me, what Lemonade did was more clever than what Root did, because Root was basically like a regular salesman approach. I'm going to be vocal, I'm going to be aggressive, and you're going to see it, and that's it. And it works. It works. What Lemonade did was kind of like an indirect approach. They made the industry very mad. They got all this PR, but consumers, they bought it. And to me, that's amazing how you can do that. If Lemonade is able to go to a psychologist, sit down and say, help us be different, but somehow still maintain our cool, then I would go with Lemonade. But if they are still stuck in their old ways, I mean, Root has an expiration date, and that expiration date is once enough consumers understand that it's just a gimmick. Just like now, agents with Assurance IQ understand that it's just a gimmick, because more Glassdoor reviews, more Indeed reviews, people see the coverage or articles. So it's going to be harder for them to convert eventually, because if everybody's saying, don't go for it, 6 months, you get a rate increase, some would say, yeah, let me save for 6 months, but some might say, forget it. I'm not here for that. But I mean, it's challenging, but what I can tell you for other insurtechs, like, you're not even in the game, because you're trying to do it the right way, and you're not vocal, and you're not aggressive, and you have no chance. You really have no chance. And the future, really, and I always say this, and I'll say it again, insurance companies do not have the right to be consumer-facing brands. You can't do it. The ones that will have the right are the car makers that maybe will partner with some insurers for better underwriting to gain that, unique advantage. Media companies, banks, fintechs, everybody that is able to say, how to generate that intent. Listen, we know you just lost your job. Let me send you a good ad and say, look, you lost your job. Now is the time to save money on your insurance. They can do that. Insurance companies, they can't. They just spend their money on marketing, Google, Facebook, agents, whatever that is, and they can't go that deep to really improve their marketing spend.
To wrap it up, I totally agree with you. It's why I actually think that the reality of this business is that if you're going to create a transformational tech stack in this space, it's to help reinsurers write business directly. That you go to agents, you go to brokers, and you basically say, hey, listen, forget about the rigmarole, right? You send me just this information, and I'm going to go ahead and write you a rate, and the reinsurer's got my back, right? Then and at some point, that's what the business. That's just what it's going to become. And in fact, it's the reinsurers that are going to go ahead and be the ones that you're going to use the carrier to, like, say, oh, you know how to. I mean, carriers are brands, and the one thing that this thing has shown, that insurtech has shown, is brands are disruptible. For sure, right? You come in with a demand generation value proposition, you can do it. My whole thing about Lemonade, where I was like, oh, maybe they have a chance, was when they started doing pet insurance. And I'm like, okay, I see the Venn diagram of a renter and pet insurance. That I get, right? Like the Venn diagram of like renters and homeowners, there is no Venn diagram. That's a you progress from one to the other. It's not you're doing both at the same time. So my personal belief when I look at both of those companies is they both approached it from two different angles, right? I think Root approached it from the angle of, if I go ahead and I say that I'm doing something different from a rating perspective, it's a great marketing tool, right? And Lemonade went ahead and looked at it and said, if I go ahead and I make it a far better claims experience, right? Like it's going to be really attractive. This product's going to be attractive. The carrier in auto with the highest retention rate is USAA. And the reason's really obvious. If you've ever had a claim with USAA, it's the greatest claim. You almost want to have a claim. Like, it's the greatest claim experience you will ever have in your life, right? Because there's no bullshit to it. There's no, like, they don't sit there and inherently distrust their customer. So both of them approached the marketing hook differently, right? For me, it just comes down to total premium, and I think it's easier to get total premium in one versus the other, and I think that's
this is going to be a question for the Cover Your Crowd. Who would they invest in, Lemonade or Root? And we'll see.
I'll broadcast it.
Offer neither as an option, just to see.
Okay. Yep, we'll add it. Hari, Avi, this is the week ending September 9th. It was awesome to get your insights. I learned a lot. So let's do this again.
Anytime.
Thank you.
I'll bring the virtual drinks next time. Thank you guys for the time.
Thanks everyone.
All right, bye.